Everyone wants to start a business, but the second you ask a bank for money, it feels like the door just slams shut. And why really is it so damn hard to just get a loan when you're trying to get started? I'm Shane Pearson. I'm an SBA lender. I'm a business buyer. I'm a deal alchemist. It's the nerdy little name I came up with myself just to talk about the weird, messy crap that I got to deal with when working on small business loans. And I've been helping entrepreneurs fund their dreams for nearly 2 decades. And in this video, we're going to talk about what real reasons startups don't actually get loans and exactly what you should do instead. So if you've been chasing a lender's approval and keep hitting the same freaking wall, just stop. Breathe. Let's reset your strategy, because the goal isn't just to get funded. It's to build a business that doesn't need permission to actually grow. Subscribe if you're serious about leveling up, and let's get into it. Let's start with the part that nobody tells you when you dream about launching a business. You hear about the SBA, you see the ads for the small business lending, so naturally you assume getting capital should be possible. You've got a great idea. Perhaps you're taking a meeting, you fill out some forms, explain your vision, and then boom, we're gonna pass for now. It's just a little too early. That's not a rejection of your idea, it's a rejection of your timing. Lenders aren't in the business of funding potential, they fund proof. They want something real, like cash flow, signed leases, operating equipment, contracts, customers, tangible assets that they can lend against. That's really all they're looking for, something to get their greedy hands on.
Mr. Krabs.
Hello, I like money.
And here's the gut punch. Debt doesn't care about your story. It lives on the balance sheet. It's not a bet on your genius, that's the equity pool. It's a trade for predictable repayment. So when you walk in with a promise, but no revenue, no assets, no history, what you're actually asking is this: will you bet everything on me personally? Unless you've got a strong personal liquidity outside of income or a real estate backing, that answer is almost always no.
No.
You didn't get denied because your idea sucks. You got denied because it's not an asset yet. Now here's the good news, and it's everything. You don't need a lender to start. You need leverage, and the best leverage early on is called revenue. Instead of chasing a loan, focus on bootstrapping. Build the business with what you've got, not with someone else's money. Sell first. Move fast. Start small. If it's a product, pre-sell before you build. If it's a service, get one client, deliver like hell, and then use that check to fund the next. Keep your overhead low. No full-time hires unless they're revenue producing. No fancy branding unless it actually drives sales. So don't spend the thousands of dollars on a logo when you can't even sell the product yet. You don't need 50 grand and a logo. You need proof. Because proof is what earns you the right to scale. Not a pitch deck, not a PowerPoint. Proof that someone will pay you for what you do. You ever watch Shark Tank? It's one of the first things. How much have you already sold?
No, I'm out.
The pre-revenue guys, they tend to work in that venture capital world, but man, you want somebody or you want a lender to back you up, start selling. Let's talk timing, because debt is powerful if you're ready. Ironically, you're most ready to take on debt when you don't actually need it, and that's how lenders tend to think about it. If you can make the loan payment easily without sweating payroll, if the money is going towards something that generates more money, if your books are clean and the numbers show a stable track record, that's when debt becomes a tool, not a trap. So ask yourself, can I afford this monthly payment with my existing cash flow? That's what your lender's going to do. Is this money going toward growth or just covering losses? Do I have at least a year or two of consistent books to prove how to manage capital? These are all questions that you need to ask yourself. And if the answer is yes across the board, then yes, you're ready to go get debt and use it like a weapon. If not, pause. Fix the foundation first. At some point, if you're doing things right, the conversation actually shifts. You're no longer begging for funding just to stay afloat. You're building something real. Sales are happening. You've got systems, you've got momentum, and now you think about fuel. You actually need the fuel to keep it running. And that's when capital starts to feel a little bit different. You're not just chasing approvals anymore. You're trying to make the right move. So where do you actually go when you're ready to grow? I know it sounds nerdy.
You are a nerd.
Where do you actually go when you're ready to grow? But let me walk you through this, because this is where a lot of entrepreneurs take a sharp left, either into debt traps or momentum killers. And it doesn't have to be that way. The SBA 7A loan is the most powerful structure in small business lending, period. It's got long terms, low down payments. It works for buying a business, real estate, even restructuring debt. And the interest rate's usually just a couple points above prime, which today would put you somewhere in the 9.5 to 10.5 range on average. But here's what nobody actually tells you, that this is not a startup money machine. This is for businesses with a pulse, a spine, a track record. There are deals out there that can work as a startup in SBA, but
Are you serious?
you'll want to walk in with tax returns if you can. Clean books, a real business plan with financials that don't look like wishful thinking. And yeah, you're signing a personal guarantee, but it isn't about impressing someone with a story. It's about showing you've already done the work, and this capital is just an accelerant. So when you're ready, it's a phenomenal tool, but if you're still trying to find product market fit or figuring out your margins, don't waste your time. You'll end up frustrated and overextended. If your business isn't stable, don't chase the SBA 7A. Build something real first. Now, on the opposite end of the spectrum of the SBA loan, you've got online lenders. They move really fast, and I'm telling you, wicked fast, 24, 48 hours sometimes. They ask for almost nothing. You uploaded some bank statements and bam, you're funded. It feels honestly like magic, almost like a quick high, but magic has a price. These loans come with aggressive repayment terms, weekly payments, sometimes daily payments, and at APR, easily way over 20%, hell, even 50% if it's hidden behind a factor rate. Can they work? Yeah, if you've got a good, real short-term cash timing issue, like bridging a payment gap between inventory delivery and a big invoice or something. But if your business is leaking money and you're hoping this loan fixes something that's structurally broken, that loan becomes an anchor. And I'm talking real fast, and you don't even see it coming until it drags your cash flow underwater. Use these only if you can see the exit ramp before you take the on-ramp. Online lenders will give you fast cash and even faster regret. The human side of lending, right? If you're still early, like really, really super early, but you've got momentum and you've got some grit, you need to hear this. Look for CDFIs, micro lenders. They're community-based nonprofits. These folks, they actually care about you. They're not just chasing huge returns. Some of them are even set up just as nonprofits. They're trying to help entrepreneurs to build local businesses that last. Loan sizes tend to be smaller, usually $5,000 to $50,000, but they'll listen to your story and they'll look at your plan. They might even pair you with technical assistance or mentorship along the way. It's a lot slower, it's more paperwork, don't be afraid of that. But if you're the kind of entrepreneur who's built more on conviction than collateral, this is your lane. It's the prove you're serious capital that banks won't give you, but your community will. Don't sleep on CDFIs. They're betting on people, not just profit. And then there's the line of credit. This is hands down one of the most underrated tools in business finance. It's a revolving credit line, just like a credit card, but built for cash flow. You draw down what you need, you pay interest on what you use. You repay it, and then it resets. There's always a catch. You've got to get it before you need it. No bank is going to hand you a line of credit when you're panicking. They want to see predictability. That means at least 2 years of financials, at least $250,000 a year in revenue, consistent cash flow. You don't wait until you're stressed. Set it up while things are stable. That way, when a vendor delays or a client pays late or an opportunity pops up, you've actually got the firepower. And you're not running around looking for a lifeline. A line of credit is like a parachute. You don't want to pack it mid-fall. Now let's talk about the hard truth. There are moments in your business when your debt sounds like a solution, but it's actually a trap, disguised as help. I've seen it too many times. A founder that gets boxed in, the pressure builds, payroll's tight, margins are thin, hope is running really low, and so they take on a loan. And not because it's the right fit, but because it's the only open door. That's the moment where bad debt decisions happen. Here's how to recognize when that loan in your inbox isn't your golden ticket, it's actually a downfall. I'll go through these step by step. Number one is really the payment will choke your cash flow. If you're calculating how many invoices need to clear before Friday just to make the payment, put a pause on. Debt should support your rhythm, not steal your sleep. If that new loan forces you to delay vendors, float payroll on a credit card, or hold your breath every time ACH hits, you're not ready. You're gambling, and business isn't blackjack. Perhaps you're masking a broken model. Look, if the business isn't profitable with the loan, then the loan isn't fuel, it's a Band-Aid on a bullet wound. Cash can't fix a bad offer. It won't save your margins. It can't make people want what they don't want. Don't borrow to avoid hard conversations. Fix that model and then scale. It's very important to understand that you can't articulate ROI. If you can't say exactly where the money's going and what it will return, you're borrowing on hope, not strategy, not data. It's just straight up hope. And that's not what capital is for. Debt should be a multiplier on something that's already working. If you can't draw a line from the borrowed dollar to the extra dollars it'll generate, you're not ready. Close the laptop, take a walk, rethink what you're doing. Here's the truth that took me years to learn and that most entrepreneurs never hear. Getting a loan isn't the goal. The goal is to build a business that doesn't need a loan, but qualifies for one anyways. That's when the leverage actually flips. That's when lenders chase you and when your business becomes bankable because it's healthy, stable, and proven. So how do you get there? It's not about faking it. It's about building with intention. Let me walk you through exactly what that looks like. First things first, stop commingling your money. If you're still running your business out of a personal checking account, that's a huge red flag. Open up a business account, run everything through it, sales, expenses, subscriptions, vendor payments. Get a booking system. I don't care if it's QuickBooks, AutoBooks, whatever the hell out there that lets you keep track of it. Heck, even the back of a freaking napkin if you can't afford that yet. It doesn't have to be fancy. It just has to be accurate. And for the love of your future self, get a CPA.
Stop it. Get some help.
Even if it's just once a year, have someone clean up your taxes, file them on time, and remove all that sketchy handwritten crap that screams disorganization. Because here's the deal. It doesn't matter how great your business actually is if it looks like a mess on paper. Lenders don't fund chaos. A lot of entrepreneurs focus on looking exciting. Viral marketing, big swings. Lenders, they're looking for boring. They want boring. Predictable revenue. Month-over-month deposits. Costs that stay within reason. They'd rather see $15,000 per month for 12 straight months than $50,000 for 1 month and a black hole the next. So even if you've got some slow quarters, that's totally fine. Just show why. It's seasonality. Makes sense. A dip in demand. Cool. Just tell them what you changed after. The secret to bankability isn't perfection. It's awareness and control. Show that, and you're already ahead of 90% of the files that a bank sees. You know what gives lenders confidence? A little bit of debt that you've handled well. Maybe it's a business credit card you've kept current. Maybe it's a vendor line you pay like clockwork. Doesn't have to be anything big, but it proves you take financial obligations seriously. Even more importantly, your cash flow. Lenders will look at your income and expenses and ask the golden question. Can this business make a loan payment without cutting into operations? If the answer is yes, and your statements back it up, you're in the game. Believe me, your numbers matter. But numbers without context, that's honestly just data. You need a tight, clean narrative that explains what the business does, how it makes money, and why this capital actually fits into your plan. You don't need a 30-page pitch deck that doesn't hit or resonate with lenders. 2 pages max. Who you are, what the business does, how the loan will help, why now is the right time for you. That story builds trust. It shows you're not just applying for money, you're actually stewarding it. Most people wait until they're desperate to apply for funding, and honestly, that's the worst time. The best time to get capital is actually when you don't need it urgently.
Huh? What?
That's when your balance sheet is clean. That's when your books are updated. That's when you can think clearly and negotiate from a place of power.
Oh, now I see. Now I get it.
So prepare early, get your ducks in a row, keep your business organized, build a relationship with the banker before you need to ask for the help. Then, when the opportunity hits, you're ready to move without scrambling. Look, if you're watching this, chances are you're building something that actually matters. You care about doing it right. You want to grow, but you're not willing to gamble with your future just to feel like you're moving. And that's what makes you different. This video wasn't about getting loans. It was about earning leverage. And when you stop chasing capital and start building with clarity, that's when the game actually changes. If you want help navigating that, you're in the right place. Subscribe to this channel, share this with someone who needs it, and drop a comment about where you're actually at in that journey. I actually read every one of these. I'm Shane Pearson, the Deal Alchemist. I'll see you in the next video.